unless you don't do any planning and get hit by a bus, you should pay zero in estate taxes.
You don't need to own NVIDIA for this to make sense. It makes it a lot more valuable. You should absolutely try to find the next NVIDIA. But this works if you're getting 10%, 8% growth a year. So how does the gift and estate tax work? The concept here, which many of you have, is that in the US, and specifically at the federal level, but also in many states, you're allowed to give away a certain amount of money without any transfer tax, without paying taxes on the amount that you give to other people. And then every dollar that you give away above that level, and we'll talk about what that is, will be taxed. Again, definitely at the federal level and in many states. So what does that look like? How much is it? Well, importantly, we're talking about a 40% federal rate and up to 12% at the state level, yielding tax that goes above 50% on those marginal dollars. And specifically with the July tax bill increasing the exemption, you can now give away, or starting on January 1st of next year, you'll be able to give away $15 million. And your spouse, if you're married, will be able to give away $15 million. And together, you'll be able to give away $30 million without paying any federal gift and estate tax. And that's during your life, when you pass away, all together. But if you give away $1 more than that, you'll start paying that 40% federal tax, assuming that you don't do the kind of advanced planning that we're going to be talking about here. In addition to that, lifetime giving limit, as I think a lot of you know, because this is the kind of giving that people do much more frequently, you can give away a certain amount every year without even using up that exemption. So you can give away $19,000 to every recipient you want to every year without ever dipping into that $15 million overall exemption. I can give $19,000 to each of my kids. My spouse can do the same. Together, we can give $76,000 away without triggering any sort of exemption or gift tax. That's a very common strategy. That's kind of on the small end. That's the first thing that a lot of people do in planning here. What we're focused on today is the bigger swings, the major trusts, the kind of things that can move millions, tens of millions, or even more out of your estate. Samani, you want to kind of talk about, introduce the Jensen story?
Yeah. So, and to this point, like now, an interesting thing to what Jeff called out is the state taxes. It's very high, like 53%, right? Can exceed what ordinary income taxes are in the highest states. The estate tax is also the easiest tax to avoid with planning and existing structures. And Jensen is a great case study of this. Of he did early planning and also helped in appreciating assets. But by the way, the interesting news is you don't even need appreciating assets to avoid estate taxes. But let's talk about Jensen. He started doing this in 2007, so a little less than 20 years ago. And since then, he saved over $8 billion in estate taxes that we can see. And the answer is it's probably higher and could be significantly higher if he had candidly really wanted to or been more aggressive. And so we'll dive into kind of what that looks like and how he did it and what were the different vehicles he used.
And really important, Monty, just to take a beat here, this story is about Jensen and it's about NVIDIA. And that makes sense because NVIDIA has been the fastest growing company in the world for several years now with no signs of stopping. At the same time, there's nothing unique about this story, right? There's nothing special about NVIDIA shares or the way the company was structured or really anything. This story applies to anyone who owns shares in a growing company, right?
Yeah, 100%. In a growing company, and this is where, if you take this from 8 billion to 800 million, there's probably hundreds or thousands of people that we could write the same story about. Really, this is focused on Jensen and NVIDIA because of, to your point, this is the hottest company. The dollars are a little bit larger, and there's been more focus, so we have more details on it. So it's easy to walk through his exact playbook. And candidly, it's not a unique playbook. We'll go through his story, but we'll also talk about how this can apply to really anyone else, to Jeff's point.
That's right.
And this is this is kind of true of most of these scenarios, but this is a grand slam. $8 billion. This is, by the way, good. And by the way, the number could have been a lot higher. And that's because he just followed the playbook of which structures to use and got started early.
That's right. I feel like we have one of these provocative quotes in all of these presentations. Last week it was, or 2 weeks ago, it was that only morons pay the estate tax. Here, this is a grand slam. A lot about this story is provocative, but the bread and butter, what's under the hood is just, hey, look, there's a number of tried and true strategies that you can take advantage of if you're, on top of this, which Jensen was, and you could be too. So we are going to be talking.
Another, I just want to say one thing is, like, it's calling a grand slam, but it's candidly giving kind of the estate space a lot of credit. A lot of this is just, if you decide to get started early, these opportunities, and Jeff's going to go into what these structures are, it's there. So the thing is, do you want to take advantage of this? Do you want to avoid those taxes? And if so, can you get started early? That's really all it takes to create a grand slam.
That's right. And when it doesn't cost anything to start early because Valor exists, that's a great way to just kind of get moving on this stuff. So what are we going to be talking about today? This article that we've been referring to mentions 4 groups of strategies, and these really map very well to the categories of strategy that we like to talk about. The first is GRATs. This is Grantor Retained Annuity Trusts. That's the splashy, well-known strategy you hear a lot about. And this is the one that had the biggest impact on Jensen's estate because NVIDIA grew so fast. And we'll explain why that is and how that worked. We'll talk about IDGTs, IDGTs. That's intentionally defective grantor trusts. Also super valuable, a very common move for people in this sort of situation, and a way to move substantial value, as you can see, out of your estate. Those two focus on the estate side and are kind of cousins of each other, and we'll talk about them together. Then we have charitable structures. This is in some ways a very different move. It's about actually giving money away, but doing so in a way that is efficient with respect to both estate taxes and potentially capital gain and even ordinary income taxes. And so we'll talk in some depth there. One thing we won't mention in too much depth is the family limited partnership. This is kind of an umbrella structure that a lot of families use. Doesn't on its own necessarily move the needle quite as much as the individual strategies, but we wanted to put it up here to let you know that it is there, and it's a concept that we're happy to talk about if it's interesting. So I'll take the first one here and talk about how GRATs work. And I prompted Monty to preview this a little earlier. GRATs are something that applies logically to any appreciated asset. I'll talk about this, but it's really important as I talk through this structure to understand that the logic here is going to apply whether you own Google shares, Meta shares, SpaceX, Databricks, OpenAI, public, private companies, any appreciated asset, and especially one that's growing fast. This is going to work for, and I'll talk about how. So what is a GRAT? It's a Grantor Retained Annuity Trust. And the concept here, before I get into the step-by-step, is that you can move assets out of your estate and then let them grow, and the growth will go to your beneficiaries totally free of estate tax. This is a very clean move, and it also has the benefit of you retaining the original principles. How does that work? The first thing you do, and what Jensen did, is you gift cash or often shares, like shares of NVIDIA, to a trust for a beneficiary, typically your kids. Let's say you move $1 million, let's say $10 million, trying to pick bigger numbers because Jensen used big numbers. You move $10 million of shares to a GRAT. Those assets, we assume that you're putting them in a fast-growing company like NVIDIA or leaving them there. Those assets grow over the term of the trust, which for reasons we won't get too deep into right now is typically 2 years. But these strategies last for many decades. It's a little bit technical. The assets grow over the trust's term. You, having given those shares to the trust, you will get back your original $10 million plus interest at the IRS's statutory rate. And we'll talk about the rate Jensen got and the rate today. So you'll get back that $10 million plus interest over those couple of years. And anything that's left in the trust will go to your kids free of estate tax. Essentially, the structure lets your assets grow outside of your estate. And so you can see how that works. If you invest that money in fast-growing shares, and you get a rate of return that is substantially more than the IRS interest rate, you're going to end up with a lot of money left in your trust, which will go to your kids tax-free. And that's exactly what Jensen did.
And I want to call out, there's kind of this dichotomy of, Jeff talked about this up front, is the gift exemption is changing to $15 million per spouse on January 1st. And so if you're thinking through this, okay, if if you're married or single, you can give away 15 or 30 million. And then you're probably wondering, how does Jensen avoid $8 billion in estate taxes when he can give away, and by the way, when he did this, the state exemption was far below 15 million. So you're probably wondering, how is he able to do that? The short answer on this is, and with each of these structures that we're going to talk to today, you can call it a loophole or an opportunity. There is a way to gift far beyond that estate exemption without paying estate taxes. The loophole for GRATs are, you can gift assets without using any of your gift exemption. So you can put this to what Jeff was saying is, all the growth above the IRS's interest rate passes on tax-free to your heirs without using your gift exemption. And so let's play this out for Jensen's scenario. He gifted $100 million in NVIDIA shares. The IRS interest rate was 1.8%. And so what that means is Jensen's, essentially the GRAT that Jensen put these shares into, has to pay him back $100 million plus 1.8 interest percent for each of the years that's the applicable rate. It's obviously pretty low, and I think everyone here, we have to explain this. You can look at this chart. NVIDIA has grown a lot faster than 1.8%. So effectively, all of that upside above 1.8% passed on to Jensen's heirs with using $0 from his gift exemption, and is outside of his estate. So it not only uses zero exemption, all the future growth once it passes on outside of his estate is also estate tax free. And this is why just on this, we've seen that he saved $6 billion in estate taxes. And honestly, the number might be significantly higher.
Yeah, I want to just do the math really quickly for people. And look, your assets, most of the assets that we all own, are not going to grow. NVIDIA has grown 225x since March 2016. So that 100 million theoretically, should be much more than that. We don't know exactly what it is. That might not be what happens, but if your assets grow 3x in that trust term or over 10 years, all of that growth is going to your kids. And importantly, as Mani said, because you're taking back the starting value, that's, you use the word loophole. I'd use the word, kind of close reading of the statute, right? These trusts are set up so that if you zero them out, which means you take back the amount plus interest, well, everything else is outside of your estate. And that's exactly, how this works.
Not to get too deep down a tangent, which I'm terrible at. The crazy thing about GRATs here is, so the way that Jensen used GRATs, it truly is a weird loophole, because the reason they exist the way they are is Congress passed a law to try to outlaw the most popular previous estate planning structure called a GRAT. Now, ignore the name. Estate planning lawyers are pretty terrible with naming. But when they passed that law, they didn't realize the impact of it. The family behind Walmart saw the opportunity or their team saw the opportunity for GRATs. They took advantage of it. The IRS sued them. The Walton family initially lost, took it to the Supreme Court. And to what Jeff was saying, they essentially found that if you actually followed the interpretation of the law, that's what allowed GRATs to exist the way they do today. And that's kind of why, Jensen, not even being very aggressive, could avoid $6 billion.
That's right. I want to call up an important question here from Arthur. Is the IRS rate still 1.8%? Did it go up? What does that mean for this strategy? This is a really important, really good question. The answer, I think, unsurprisingly to everybody, will be no. The IRS rate is not still 1.8%. It did go down from 2016 all the way down to about 0.5% in 2020, which would have been a great time to do a GRAT. Today, this month, it's 4.6%. And so the candid answer here is, mathematically, that is slightly worse for someone setting up a GRAT, because you now have to beat a 4.6% hurdle rate to get anything to your kids. But really importantly, if you model this, you'll find that is not a hard number to beat, right? Most of us are investing for a much more significant growth rate than 4.6%. And that growth in the interest rate doesn't actually drag down the overall returns, and certainly does very much, and certainly doesn't kind of upend the logic here. If you beat 4.6%, then money's going to go to your kids tax-free, estate tax-free. And that's still true whether the rate is 0 or 2 or 6 or even 8, right?
Yeah. Yeah, and this is an important piece to call it is, yes, returns are lower. By the way, historical S&P growth rates are, about 10%. So this is where of like most, even bonds are typically, corporate bonds are above 4.6. So it's not, yes, it's higher, but it is still typically below what you're able to return. if you're investing this in anything beyond.
Yeah, and that's actually a really
treasuries.
important point. We are focused on someone who put the fastest growing stock in history into a GRAT at the perfect time. We have plenty of clients, and there are, as Monty said, thousands of families, probably millions of families, who have set up GRATs and just thrown the S&P in there and gotten their 10%. Maybe 1 year it's 20, maybe one year it's 0, and that is a killer strategy too. You don't need to own NVIDIA for this to make sense. It makes it a lot more valuable, and you should absolutely try to find the next NVIDIA. But this works if you're getting 10%, 8% growth a year, even at the current.
If you do have the next NVIDIA, please also share in the comments. I'm mostly joking.
So we don't need to belabor this point. We're running long as usual. This is just an important point very quickly, as we said, and this is kind of consistent with what we've been talking about. This strategy is agnostic as to the asset. If you've got an asset that is going to grow fast in the future, then the kinds of things we're talking about here today, GRATs, IDGITs, charitable planning, absolutely make mathematical sense. And there are, at this point, tens of thousands, maybe bordering on more than that, individual shareholders, early shareholders at these companies, or honestly, not even that early, right? We're talking about folks getting 0.1% of OpenAI today and having $10 million of stock. Those are precisely the kinds of assets and shareholders and employees who can take advantage of these strategies.
Yeah, and this is the reason we have these 3 companies. These are some of the examples of people we work with, and they're doing these exact strategies for all of these shares here.
Yeah, I think the important point here is that someone owning early equity, or especially early equity in a company that grows like this, has major upside that you can capture and grow with additional tax planning. Pre-liquidity planning is especially valuable. It's an important point with all 3 companies listed here. And that getting started on this stuff reasonably early, like Jensen did, is key. And that's why we chose these companies. It is still early days for all 3 of these. But that's true of, again, hundreds of companies out there whose value is growing substantially. Monty, you want to talk about kind of how we quantify this stuff?
Yeah, and this is to kind of what Jeff was saying earlier. I'm just going to pull this up. This is an example of one of the tools we have. This is really accessible. We'll share this in the chat. This is just an example. So we're going to take, this is the GRAT structure that we're talking about. By the way, we have this for all the different structures. And the point is to help illustrate what is the value of this structure. So let's say you put $10 million into a GRAT. You can adjust this number. Let's say this is growing at 10% per year and you're 50 years old. What this is saying is that if you just use a GRAT, and by the way, you're going to use other structures as well, you could, assuming that 10% growth and a normal expected kind of, you're going to live as long as a typical 50-year-old, you would be able to pass on somewhere between $274 to $300 million after estate taxes to your heirs. Versus if you didn't use a GRAT, you'd pass on 158 million. So it's roughly doubling how much you can pass on. And this is with a 10% growth, right? So if we increase this, if you have the next NVIDIA, these numbers go up dramatically because of compounding. And so, even if you're more conservative, let's say it's an 8% growth, it's still slightly less than doubling what you pass on. Really, the whole point of this is how you get to kind of the Jensen of avoiding $8 billion. This works for really any amount where you're facing the estate taxes. And we're going to share this in the chat. But the broad point is, if you're worried about estate taxes, you want to get started earlier versus later. And this will help you figure out what's the magnitude and what's part of the plan to get there.
That's right. I want to take a moment to just drive home. Yes, early planning is important. We'll talk about what happens if you haven't planned early. And the answer is it's not too late, really, ever. But really importantly, it costs nothing to figure out if now's the time. We have the tools, and it's worth just having a conversation with us or with any planner, but especially us, to figure out, what are those early steps you can take? What are the reasonably low cost, non-invasive, low overhead things you can do to capture the kind of value that Monty was flagging there?